Hello everyone, welcome back. This is CA Bhavin Gandhi with yet another video on revision for your CA final AFM, and this time we're going to revise business valuation chapter. So business valuation along with mergers and acquisitions, both these chapters are extremely important from the examination perspective. You can always expect a question on this. Extremely scoring from the examination perspective. So let us revise this entire chapter very thoroughly. This is going to be a short video, and it's going to cover all the concepts on business valuation, all the important parts of the questions. Wherever I feel the need, I'll be visiting all the important parts. And also at the same time, we'll be covering EVA, MVA, etc. Everything in this particular chapter, whatever is there in a study module, everything will be revised very thoroughly. But as you all know, what you need to do is keep your notebooks handy, keep your calcies handy, revise this entire chapter with me. Wherever you feel that there is a need for you to solve the question, I'll be displaying the solution. You can just pause the video, solve it on your own, but make the concepts crystal clear. Okay. So let's get started without wasting any further time about what is your business valuation. So basically, as you all know, valuation is nothing but the process of determining the true worth of your investment. So here we are going to learn how to value your business. Okay. So basically, business valuation is done prior to mergers acquisitions. Why? Because an acquiring company will always value a target company before its acquisition. Business valuation has been done before we list the shares of the particular company on an exchange. Business valuation is done for various transaction deals. It is done by the stakeholders of the company. So there are many participants who can undertake this activity of business valuation. Prima facie, we will categorize the entire valuation into two main models. The first one, we call it as your historical model. So basically, in your historical model, we have, valuation which is based on the financial statements. So basically, when we deal with your historical models, uh, we have net asset value as the method for valuing a particular business, and then we also have something which is called as adjusted net asset value. And similarly, my dear students, that when we are valuing, companies or businesses based on your modern techniques, these involves what? Estimating the future economic benefits which will be generated from the business, and we need to discount it and bring it to the present value terms. So, in this modern techniques of your business valuation, what we need to do, we have to estimate. We have to estimate what is going to be the economic benefits which will be derived from it. Then we will discount it and we will bring it to the present value terms. So in modern valuation techniques, we'll be using free cash flow for firms and free cash flow for equity. These are the two main models where we'll be estimating the economic benefits, then discounting it and bringing it to the present value terms. So my dear students, very simple concept that whenever you think about business valuation, it's broadly classified into historical methods and your modern techniques. Historical methods means visiting your financial statements, looking at the net asset value or the adjusted net asset value, or if you want to value the particular business, then you can estimate your future benefits which will be derived in the form of FCFF and FCFE, discount it and bring it to the present value terms, right? Now, let's start with the basic net asset value. Now, net asset value, as you all know, it's nothing but your equity shareholder funds, okay? So now in this particular case, we can calculate the same using either asset side approach or your liability side approach. Your asset side approach will have what? Fixed assets, it will have long-term investments, it will have current assets. And then from this, we'll be subtracting current liabilities, long-term loans. Ultimately, my dear students, will be getting your equity shareholders funds. Now, we have to pay attention here that whenever we are dealing with equity shareholders funds, what is your equity shareholders fund? So we take into consideration your equity share capital plus reserves and surplus, and from this we subtract your miscellaneous expenditure not written off. So will this give your equity shareholders funds? Come on, yes or no? Yes, sir. Which brings to a conclusion that whenever we are calculating the net asset value, if you are following asset side approach, we have to also subtract your preference share capital. So preference share capital is not forming part of your equity shareholders funds. Okay, so I'll explain this with the help of an example. Suppose we have plant and machinery of, let's say, 100 crores. We have land and building of 50 crores. Then let's say we have your stock, which is example 30 crores. we have debtors, which is 10 crores, and then we have cash bank, which is also 10 crores, and then we have miscellaneous expenditure not written off. So what is this miscellaneous expenditure not written off? Have you heard about, preliminary expenses or underwriting commission or, discount on issue of debentures, all these things which we are supposed to write it off, but it's not written off. So let's say, for example, that is also 10 crores. So this will now be your total 210 crores. And let's say, for example, on your liability side, we have equity share capital, we have reserves and surplus, we have preference share capital, then we have long-term loans, then we have current liabilities. Suppose your current liabilities amounts to rupees, let's say 20 crores, your long-term loan is 30 crores. Okay, this is 50, and let's say 100 crores is a preference share capital. So this will now become 150 and 150, and the total of this is, let's say, for example, the total of this is now 60. So this together will give you 210, right? 60, 30, 90, 20, 110 and 210. So now, my dear students, when we are talking about your net asset value, so what you need to do is, we have to, from the asset side, subtract your outsiders liability. So in the asset side approach, what do? We take plant and machinery, land and building, stock, debtors, cash and bank. Okay. And from this, we will subtract outsiders liability. So we'll be subtracting current liabilities, we'll be subtracting long-term loans, and we'll also be subtracting your amount of preferential capital. So that is why the total of this will now become what? 150, 30, 180, 190, 200. And from 200, now I will subtract my preference share capital of 100, my long-term loans of 30, and my current liabilities of 20. So this together will now give me 50. This is my equity shareholder funds, which is also the net asset value of the particular company. But this can also be calculated correspondingly by using your liability side approach, where we'll be taking your equity shareholder funds. And what is that? That is equity share capital plus reserves and surplus. From this, I subtract miscellaneous expenditure not written off. So what's your equity share capital plus reserves and surplus? This is 60. What is miscellaneous expenditure not written off? 10. So this will now give you equity shareholders funds of 50. So I hope, my dear students, you all are understanding this, that both these things are going to be the same. But here the crux was that whenever there is preference share capital, we don't take part as the net asset value. Okay. Then, my dear students, we have something which is also called as adjusted NAV. So what do I mean by adjusted NAV? So in adjusted NAV, all these assets, we have to take into consideration their realizable value or their revalued amounts. So basically that will be given to you in the question. So let's say, for example, they tell you that plant and machinery is now having a realizable value of 80. Land and building is, let's say, for example, valued at 120. Stock, it can only be sold for 20. If there are debtors, there is a bad debt of, let's say, 5. So this will be now 5. Suppose your cash bank is 10. So when I'm talking about adjusted NAV, what we need to do is, we have to take these particular assets, okay, the revised value of the same, and then subtract this outsiders liability, and ultimately we'll be getting the adjusted NAV. So in the question, if they ask you that we are required to value the business based on NAV, then we can simply take asset minus outsiders liability, or else on the basis of your realizable value, we can do it on this particular basis and calculate the final amount. Okay. So these are based on historical approaches, and here we are going to take into consideration the financial statements, but not very much practical, right? Because based on this, if you want to value a startup, it's not possible to value, because there will be a tremendous P&L debit balance. So in that particular case, the valuation will definitely go in drain. So in such kind of companies, what happens is that we take into consideration your modern approaches. So here we will be discounting all the future value of the cash flows into present value. So here now I'm introducing to you the basic difference between what is free cash flow for firm and free cash flow for equity. Okay. So just pay attention that the format of the income statement, as you all know, is we start with sales. From this we subtract variable cost. What do we get? Contribution, from which we subtract fixed cost. We get your net profit before interest, depreciation and tax. Then from this, if I subtract my interest part first, or let's say, for example, if I first subtract my depreciation part first, so this will now give me something which is called as EBIT, earnings before interest and tax, which we know it as your operating profits. Then from this, if I subtract my interest part, I get EBT, from which if I subtract tax, I'll be getting my net profits after tax. To this, if I add the amount of depreciation, what will I get is my cash inflows. Now, my dear students, whatever cash inflows which we get, are we supposed to now adjust those cash inflows or not? So the answer is yes, but it depends upon what type of a model it is. So now let's talk about free cash flow for firm. Now, free cash flow, let's say first let us start with free cash flow for equity. What is free cash flow for equity? Free cash flow for equity actually means that if you want to value equity of a particular company, we need to check what is the free cash available only and only for equity shareholders of the company. So whenever we need to take into consideration only and only for equity shareholders of the company, what will we do? So when we talk about FCFE, okay, cash available only and only for equity shareholders. See, equity shareholders are the true owners of the. For them, the cash which will be available, that will be the last cash. Okay, that will be after taking into consideration all your fixed obligations, etc. So the final cash that is available for your equity shareholders. So as you all know from the sales, if you subtract variable cost, if you subtract fixed cost, if you subtract depreciation, then we get EBIT. We subtract the interest element, we get the EPT, tax, NPAT, and then we add back the amount of the depreciation. We will be getting the cash inflows. So these are the final cash, right, which is coming in the business. But my dear students, it is very much possible that with the amount of this cash, the company is planning any expansion. So whatever is the increase in your fixed assets, we can, eliminate that as well. So from this cash inflow, what do we subtract? Any increase in fixed assets, we can subtract it because that much money is going to go to your equity shareholders. That much money is going to go for the acquisition of the fixed assets. So the amount available for equity shareholders will be relatively less. Also, my dear students, there will be, if there is any increase in working capital, we need to subtract that as well. If suppose there is any let's say for example repayments of loan, so repayment of principal amount of loans, that all will be subtracted. So if suppose the management of the company is planning something like this, that we want to expand, and if we want to expand, we have to invest in the fixed assets of the company, if we have to invest in the working capital of the company, then because of all these things from your cash inflows, we subtract your investment in fixed assets, we subtract your investment in working capital, we repay our loans. So because of that, can I say that the free cash available for equity shareholders will be relatively lower? Come on, yes or no? Yes, sir. Okay. So for the purpose of valuing equity, we take into consideration this FCFE. Also, now if we talk about FCFF model, free cash flow available for the firm, now we need to check that how much is the cash available for all the stakeholders of the. Now to check how much is the cash available for all the stakeholders of the company, that is including your debenture holders, I cannot subtract the amount of the interest. Why? Because if I want to calculate what is the total value, what is the total value, FCFF actually means what is going to be the total value of the company. So now I'm not valuing just equity, I'm valuing equity plus debt both. That is nothing but market value of the company. So for that particular situation, all the stakeholders, they want to see how much cash is available for them. Okay, so are we going to subtract the interest element? Then the answer is absolutely no. So how will your income statement now look like? So it will be nothing but again sales less variable cost, then we'll be getting contribution minus fixed cost. We get net profit before interest, depreciation and tax. If we subtract your depreciation, we get EBIT. Now this EBIT, my dear students, we are not going to subtract any interest out of it because we want to check how much is the cash available for even the debenture holders of the company. So if I subtract the interest, then the cash available will be relatively lower. So we don't do that. So from the amount of the EBIT, we directly subtract what? Your tax. So we get your post-tax operating profits. So that will be called as net operating profits after tax. And then to this, we again add back the amount of the depreciation, we'll be getting the cash inflows. Okay. So this is the cash inflow which now needs to be adjusted by, if there is any fixed assets purchased, yes, definitely we'll be subtracting it. If there is any increase in working capital, yes, that money is also getting blocked, so we need to subtract it. But my dear students, if there is any repayment of loan, no, 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 we are not going to subtract. Okay. So ultimately, we are going to get what? Your free cash flow available for firm, because we need to check what is amount which is available to all the stakeholders of the company. So that's why your FCFF will not be after subtracting your repayment of loan. Okay. So by the way, just to make you understand, if there is any loans taken also, so what happens here is we can add the amount of the loans taken. Okay. If there is any release in working capital, then what do? We add any release in working capital. If you are going to sell any particular fixed assets, so even that needs to be added here. So this together actually will give you the correct cash flows. Okay. With my dear students, in this particular case, we simply have to take FCFF. We are going to prepare the entire income statement. We have to check if there is any repayment of loans or not. So there is no repayment of loans, which we are going to subtract, and ultimately we'll be getting FCFF. Now, my dear students, this FCFE, if I need to value, this will be used to calculate the value of equity, and this will be discounted always at your KE. And for FCFF, we actually value the entire firm, and for this, we take into consideration your Q. Okay. So this is the prima facie distinguish between FCF and FCFF. Okay. I hope you have understood this. So now very quickly, I just want you all to come to your questions, and we will discuss the terminal values, etc. later on, when we'll be seeing that in a particular question. Let's start with revision of question number 1. Now, AB is planning to acquire and absorb the running business of XY. So we know AB is your acquiring company and your XY is your target company. The valuation is to be based on the recommendation of the merchant bankers, and the consideration is to be discharged in the form of equity shares to be issued by AB. So now, my dear students, an acquiring company is actually an acquiring company is actually discharging the purchase consideration by the way of issue of equity. So it's an only equity part. Okay, so there is no cash consideration which is given. It's an only equity part. As on 31st of March 2006, the paid up capital of AB consists of 80 lakh shares of rupees 10 each, and the highest and the lowest market quotation during the last 6 months was 570 and 430. And for the purpose of the exchange, the price of the share is to be reckoned as the average of the highest and the lowest market price during the last 6 months ended 31st March 2006. And XY's balance sheet as at 31st March 2006 is summarized below. So we have your share capital, and here we have 20 lakh equity shares of rupees 10 each fully paid up. Then we have 10 lakh equity shares of rupees 10 each 5 paid up. We have loans, and then we have total. And where are we applying this? So there is fixed assets, which is 150, and then there is net current assets, which is 200. The total is 350. An independent firm of merchant bankers engaged for the negotiation have produced the following estimates of the cash flows from the business of XY Limited. So for the year ended 31st March 2007, by the way of after-tax earnings for equity, that is 105 lakhs. Then for the year 2008, 9, 10, and 11, this is nothing but the earnings after tax for equity which they have given to you. The terminal value estimate is given to you as 200 lakhs. So whenever the business will be terminated at the end of the 5th year, 200 lakhs is something which will be received by 200 lakh rupees will be received at the end of the 5th year. So that we call it as terminal value. So which we need to discount it, and then we need to bring it to the present value terms. It is the recommendation of the merchant banker that the business of XY may be valued on the basis of the average of aggregate of the discounted cash flows at 8% and the net asset value. So now, my dear students, when we are valuing this particular business, so there are two methods which we have to take into consideration. One is your discounted cash flow methods, and for this particular case, we are going to take 8% rate. And the second one is your net asset value. So for net asset value, we are going to use historical approach. And the present value at 8%, we have these factors which are available. So we are required to now calculate what's the total value of the business of XY, the number of shares to be issued by AB Limited, and the basis of allocation of the shares. So how should we approach the question? First of all, my dear students, whenever we are going to talk about net asset value, as I told you that there are two approaches for the same. The first one is your asset side approach. The second one is your liability side. Now, what happens in your asset side approach? So from the total assets, we'll be subtracting your outsiders liability, we'll be getting NAV. Okay, and as you all can just check, we have the total assets which are available here. So that is 350. Okay, and from this we'll be subtracting your outsiders liability, and here there is only one outsiders liability, that is in the form of your loans. So we'll be subtracting that, and this will eventually give you NAV of 250 lakhs, which we can also take it by equity shareholders funds directly 250 lakhs. And now the second method, where we will be discounting the cash flow. So what do you do with the same? So all these cash flows which they have given to you. Okay, so they have specifically mentioned to you cash flows, and that can be for equity, whatever. So we'll be taking all these cash flows, and the terminal value at the end of the fifth year, all these cash flows will be discounted 8%, will be getting your 592.4. So what will be the total value of the business? As they have told you that we have to take the average of the same. So based on that, it is nothing but 421.2 lakhs. So this will be called as your valuation of XY Limited. Now, my dear students, what's the second part? The second part of the question is what are the number of shares to be issued by AB Limited? So they have told you that to issue the number of equity shares, it will be issued at the average of the highest and lowest market price. See, there are different ways to meet the purchase consideration to the shareholders of the target company. One of the ways what? That you can tell the shareholders of the target company that we are ready to give you the payment in cash. One of the ways what? That we can issue the equity of the acquiring company. Or then the last way is we can take into consideration combination of cash and equity. So here the entire purchase consideration, which is the value of the target company. How are we meeting? So we are meeting that by issuing shares of the acquiring company. Now, if suppose you are the shareholder of the target company, you will always want, yes, sir, in this particular case, what should we consider as the market price of an equity shares? Okay, now you must be wondering like this, sir, if I am a shareholder of the target company, and let's say for example the value of the target company is coming as 100 crores. Okay, now the 52-week high, example, the 52-week high share price of the acquiring company is, let's say, 100 rupees, and the 52-week low price is, let's say for example, 50 rupees. Now you are a shareholder of the target company. If you want to see that what should be the number of equity shares which should be issued by the acquiring company to the shareholders of the target company, so how will you do that? So one of the ways what, that if this is 100 crores, you can simply divide it with what, you can simply divide it by, you will tell, okay sir, let us consider 50 rupees as the share price. Okay, let us consider 50 rupees as the share price, so that 2 crore shares will be issued by the acquiring company to the shareholders of the target company. So a shareholder of a target company will always want more shares to be coming from the acquiring company. So that is why he will always set the price at rupees 50. But acquiring company, they will always want, the price of this particular share which should be fixed for the purpose of issue of equity shares, that should be 100 rupees, so that lesser number of equity shares are issued. Okay, so acquiring company will always want lower number of shares which should be issued to the target company, and target company always want more number of equity shares should be issued. So target company will always fight for the lowest market price. Acquiring company will always fight for the highest market price. My dear students, we need to take the average of this. So the average of this is, let's say, 75. So the negotiation will happen in such a way that they will take the average of it, and on that particular basis, that will be the number of equity shares which will be issued by the acquiring company to the shareholders of the target company. So here also it is specified, my dear students, that the highest and the lowest is 570 and 430, but we have to take as the average of the highest and the lowest. So which is 570 plus 430 divided by 2, which will give you an average price of rupees 500. So as you all can just check, my dear students, you will be having the value of the target company, and based on this, this will be 0.8424 lakhs. So 84,240 shares that should be issued by the acquiring company to the shareholders of the target company. Now, what is the basis of allocation? So, my dear students, the basis of allocation is we have to see whether this is fully paid or this is partly paid, because here there are, see, two classes of equity shareholders. One, it is fully paid, one, it is partly paid. Now, what do you mean by this? See, for every one share of the target company, if it is fully paid, and if I'm issuing one share, then it's okay. But if someone has just paid part of the amount, so let's say, for example, you are an equity shareholder of the target company, but you have just paid 5 rupees per share in the target company. Now, if I just issue one share to you for exchange of one share, then you will be extremely happy. But the equity shareholders who have actually paid full entire 10 rupees, they will be dissatisfied. Why they will be dissatisfied? Because they will be like, "Yes, sir, we actually want 100%. We want, if we have paid fully paid up, then if we are getting one share for every one share of ours, and if there is someone who has just paid some amount of it, he should not be given one share for every one share, because the amount paid by that particular equity shareholder is relatively lower. So that is why the first thing which you have to understand is that look in the question if there are any classes of equity shareholders or not. In this particular case, there are two classes of an equity shareholder. One, it is fully paid. Second, it is partly paid. Now, if it is fully paid and partly paid, I cannot have equal distribution of shares to both the equity shareholders. So what I need to do is, I need to check that what is going to be the first total amount. So this is 200 lakhs, this is 50 lakhs, right? So now in this particular case, uh, as you all can just check that here we have uh, the bifurcation based on 200 lakhs and 50 lakhs, which is the total amount which is being paid, which is here given to you 250. So that is why if you take on your calci, uh, you know, if you take on your calci 84,240, right? These are the shares which are supposed to be distributed. And then if we divide that by 250 and multiply that by 200, then you will be getting 67,392 shares. So these are the shares. So we have to now divide this on the basis of the ratio of the amount which is being paid in totality. Okay. You can't divide this in the ratio of 10 and 5. Why? Because that will be completely injustice. Because if suppose, let's say, here the number of equity shareholders are less. So let's say, for example, here if there are only 5 lakhs, and here if suppose there are, example, 295, something like that. Then in that particular case, if I just divide on the base 5 and 10, so here partly paid up shareholders will still get more number of equity shares. So we can't do that here. So that is why we have to always take this bifurcation based on the amount which we are paying. Okay. So based on this bifurcation, we come to know that there is 67,392 shares and there is 16,848 shares. So this 84,240, we are going to divide this into two main parts. And now, my dear students, once we get, again, I'm repeating, how did we get this particular part? So 84,240, we need to divide that by 250 lakhs into 200 lakhs. So this is the ratio, 200 lakhs and 50 lakhs to get this 67,392 and 16,848 shares. And what is the number of equity shares which they are presently possessing? 20 lakh and 10 lakh. So that is why you can see the exchange ratio of one share, it is 0.033696, and here for every one share it is 0.016848. So as you all can just check that the partly paid up shares are exactly getting half the shares of the fully paid up. Okay. So if you take on your calci 0.033, 0.033696 and simply divide that by 2. So you'll be getting 0.016848. So this is going to be your partly paid up number of equity shares. Okay. So it's going to be exactly divided by 2. So with this, my dear students, we are now done with your very first question. I hope you have understood all the three parts. We have done it. We have revised it very thoroughly. Okay. Now let us start with the revision of your second question. The valuation of Hansel has been done by an investment analyst and based on an expected free cash flow of rupees 54 lakhs for the following year and an expected growth rate of 9%. The analyst has estimated the value of Hansel to be rupees 1800 lakhs. However, he committed a mistake of using book values of debt and equity. The book values weights employed by an analyst are not known, but you know that Hansel has a cost of equity of 20% and the post-tax cost of debt of 10%. The value of equity is thrice that of book value, whereas the market value of the debt is 9/10 of its book value. What is the correct value of Hansel? So this question looks little bit tricky, but your interpretation to the question is very important. So basically, whenever we are valuing a company, always keep this in mind that we take into consideration whatever is the economic benefits, and those economic benefits we discount it at KO, and that's how we get the value. Now to calculate that KO, if suppose we are calculating free cash, if we are calculating the value of the firm, so what are we going to take into consideration? Free cash flow for firm, right? And those free cash flow for firm, when we take it into consideration, we will discount it at KO, right? And based on that, we'll be getting present value, the entire value of the company. So for the purpose of calculation of KO, we need to take into consideration your debt equity. We have to take weights. We have to multiply that after tax COC, and then ultimately we'll be getting WACC. So what weights we need to take into consideration? The weights we need to take into consideration, whether it should be book value weights or market value. Always remember that KO will be calculated based on market value. But here the analyst, while valuing the KO, while valuing the company, they actually took KO based on book value weights. Now, this is unfortunate. So we have to find out the correct value of the company, because we already have the wrong value of the company, but that is based on the wrong KO, where book value weights are taken into consideration. But we need the correct value of the company. For that, we need to take into consideration your market values. So let us first check what's the data given to you in the question. I hope you all have understood, first of all, what's the approach, that we have valued the company based on book value. We have to value the company based on market. So here, based on an expected free cash flow of rupees 54 lakhs for the following year. Now, how did you come to know that this is free cash flow for firm? You have to read between the lines. It is mentioned that the valuation of Hansel Limited. So this is the entire valuation of the company. So for valuation of the company, what is the base I've taken into consideration? I've taken FCFF. So based on an expected free cash flow of 54 lakhs for the following year. So wow, this is free cash flow at the end of the year. The expected growth rate is 9% and the value of Hansel is 1800 lakhs. Now, first of all, tell me that here this value is considered by taking book value rates. So this is actually a wrong valuation. So the first step you need to do is you have to find out the wrong KO. So how will you find out the wrong KO? So wrong KO, identify your wrong KO. Based on this, we calculate, we get the wrong KO of 12%. We are just simply applying this in the formula. We'll be getting this wrong KO as 12%. And now, my dear students, let us check what is the book value weights based on this wrong KO. So do we have the cost available? Yes, sir. We know that the cost of equity is 20% and the cost of debt is 10%. So my dear students, we know that the book value weights presently, the moment we solve this, we know that the book value weights which is coming is debt 80% and your equity is 20%. So we have 0.8 debt, we have 0.2 equity. Now, my dear students, we have to convert it into market value weight. So for market value weights, they have told you that the market value weight of debt is 9/10 of its book value. Okay. And the value of equity is thrice of its book value. So basically, here, whatever is the book value I've written here and multiplied by 3, so that is 0.6. And this is 9/10 of it, so 0.72. But we always calculate weights as a proportion of 1. So that is why 0.72 and 0.6, this is 1.32. So now we have to take into consideration in the proportion of weights, the total of which should be 1. So that is why this will be 0.55, 0.45. After tax cost of debt we have, so we have got 14.5%. Is this your correct KO? Yes, sir. Now, once we have this as correct KO, then we can apply this in the formula and then eventually get what is the correct value of the company. So these are the simple steps which you need to follow, okay, for the purpose of doing the valuation. Identify the wrong KO, calculate the book value weights, calculate the correct value of KO using market value, and calculate the correct value using your KO. Okay, so this is what we need to do. Now, my dear students, let us start with your next question. Now, this is very easy. In this particular question, I just need to highlight an important point. And that is, my dear students, whenever we are valuing a particular company, just make sure that if there is any extraordinary gains or losses, that we don't consider it for the purpose of valuation. Okay, so this is something which is important in this particular part of the question. So as you all can just check that there is an extraordinary item of 8 lakhs and extraordinary loss of 10 lakhs. So we already have your sales, material cost, labor, fixed cost. We'll prepare the income statement. The tax is this is 77 lakhs, which is actually your NPAT. So Eagle's current NPAT is 77 lakhs. So basically, your NPBT minus tax will actually give you your NPAT. So your current NPAT is 77 lakhs. But my dear students, what we need to do is, if suppose this is 100, this is 30, this is 70, first we need to calculate your NPBT. And then this NPBT actually has extraordinary income and extraordinary loss in it. We need to readjust it because we cannot use this for the purpose of valuation. So that is why you all can just check that from this 110 lakh of NPBT, whatever is the extraordinary income, I've subtracted it, and whatever is the extraordinary loss, I've added it back again. Okay, because this profit had extraordinary income, so I want to eliminate it. So that's why I subtracted it, and any extraordinary loss, I added it. So eventually I got 112 lakhs. Now, whatever is your existing operations of NPBT, I need to also check from the new project, am I earning any extraordinary from the new project, am I earning any income or not? Then in this particular case, yes, from the new project, I'm earning 28 lakhs. So total is 140. The tax rate is 30% and we'll be getting the NPAT of 98 lakhs. Now this 98 lakhs, I need to capitalize by 14% to eventually get my value of the company, which is 700 lakhs. So that is given to you in the question. So this was something which was important. And in the second part, they have just told you that if there is preference dividend, then what we need to do. So we have to prepare the income statement, and here we have to subtract the preference dividend. So net profit for equity shareholders. What should be the NPS they have asked you? So it's very much manageable. Now, my dear students, we'll do question number 4. Let us read this question. H agrees to buy over the business of B. So we have acquiring company, we have the target company with effect from 1st of April 2012, and the summarized balance sheet of H and B. They have told you as on 31st March 2012, which are as follows. So we have paid up share capital, in which there is equity share of rupees 100 each, 350 rupees in cross, equity share of rupees 10 each, and which is 6.5, and then there is reserves and surplus, which is 950 and 25. Then on the asset side, we have net fixed assets, net current assets, and then we have deferred tax assets, which they have mentioned. H proposes to buy out B. Okay. And the following information is provided. So just listen to this. What they have told you, that the weighted average post-tax maintainable profits of H and B for the last 4 years is given to you as 300 crores and 10 crores. Wow. So we already have in this particular question what is going to be the weighted average post-tax maintainable profits. My dear students, they have only given to you in the question that this is nothing but your post-tax average profits. Okay. Both the companies have the capitalization rate of 8%, and H has a contingent liability of 300 crores. And H should issue shares of 100 each to the shareholders of B Limited in terms of the exchange ratio, which is derived on fair value basis. So what is fair value? So we have to consider weights of 1 and 3 for the value of the shares, which is arrived on net assets and earning capitalization method for both H and B. And you are required to first find out what's the value as per NAV, then what is earning capitalization, what's the exchange ratio. My dear students, let's talk about NAV first. So when we are talking about NAV, first of all, what is NAV? As per liability side approach, we'll be simply taking equity shareholders funds. So whatever is the equity shareholders funds of H Limited, we have taken that. But your institute assumes that whatever is the contingent liability, if it materializes in the future, so we need to adjust that. Okay. So from this 1300, now 300 crores of whatever is the contingent liability, we are subtracting it. So that brings us to 1000. Okay. So always remember like this, my dear students, that whenever they give you uh, any kind of contingent liability, obviously it will not be recorded in the balance sheet, but what we need to do with the same, so we have to, in this particular case, whatever is your contingent liability, we have to subtract it. Okay. And ultimately get 1000, and this will eventually give you a number of equity shares is 3.5 crores. So that will give you on per share basis 285.71. So this actually is also called as a book value per share. Okay. For B Limited, there is no such contingent liability, so we'll be getting as 48.46. Now, as per earning capitalization method, so do we have earnings for A and B both? Yes, sir. What is the capitalization rate which is given to you? 8%. So that will eventually give you 3750 and 125 crores. Because what is capitalization? See, capitalization is the process of simply taking the benefits and dividing that by the capitalization rate. We generally do that when we know that profits are going to be constant till perpetuity, or when the cash flows are going to be constant till perpetuity. So what we usually do is, let's say for example, if I know that the dividend is 10 rupees, which will be constant till perpetuity, and if I want to find out the value of an equity share, how can I do it? I can simply take 10 and capitalize that by, let's say, 10%, so 100 rupees. So this will be treated as the value of an equity share. Okay. So usually this is the fund. Okay. So whenever there is value per share, which we need to calculate, or value we need to calculate on the basis of the earning capitalization method. And if it is constant in perpetuity, we can simply take the earnings and capitalize it. By whatever is your capitalization rate, ultimately we'll be getting the total value of the company. Okay. Then, my dear students, they have told you to calculate the exchange ratio, but to calculate the exchange ratio, we have to calculate this on the basis of what? There is some fair value they have taken into consideration. So whatever is the fair value of target company, from that we are going to divide that by the fair value of the acquiring. So whenever, my dear students, exchange ratio needs to be calculated, how do we calculate the exchange ratio? Suppose whatever is the parameter, your fair value is the parameter. So fair value of target company, we divide that by the fair value of acquiring company. Now, why do we do that? Suppose, let's say target company has a fair value of 100 and acquiring company has a fair value of 50. So target company will need 2 shares for every 1 shares. Okay. Suppose if this is 50 and if this is 100. So that will be 0.5 is to 1. 1 share, they will be receiving only 0.5. So my whole point here is that whenever we are required to calculate what should be the exchange ratio, that exchange ratio can be calculated by taking fair value of the target company. We are going to divide that by the fair value of the acquiring company. So the question arises, how do we calculate this fair value? So for that, they have told you in the question that please consider weights of 1 and 3 for the value of shares arrived on NAV and the earning capitalization method. So first of all, do I have the book value per share available on NAV? Yes, sir. That is 285.71. I need to multiply it by 1. Okay, because we have to assign weights of 1. Do I have as per your earning capitalization method? Yes, but I need to assign weights of 3. And then on this particular basis, if I divide that by 4, ultimately I'll be getting 875. So this is nothing but the exchange ratio based on your fair value basis. Again, for B Limited, we'll be getting the fair value 156.35. So what you need to do is take 156.35 and divide that by 875. So you'll be getting 0.18 is to 1. So that is the exchange ratio. Okay. So here you have to understand that fair value is calculated by taking two methods. NAV also, historical, earning capitalization method also, your modern technique. But we are not simply taking simple average as we had done it in the first part. Here we are going to use weighted average. Why? Because weights is given to you in the question. So we have to multiply that by 1 and here we need to multiply it by 3. And then we have to divide that by 4. Ultimately, we'll be getting 875 and 156.35. So that is how, my dear students, we'll be getting the value of your NAV, this and the exchange ratio as well. Okay. Now, my dear students, question number 5. So let's read this particular question. What is given to you? Your question number 5. So let's read the question first. ABC is considering a new sales strategy that will be valid for the next 4 years, and they want to know the value of the new strategy. And following information is given to you. So we have the income statement, sales, we have gross margin, then we have administrative selling and distribution expense, we have NPBT less tax, we have NPAT, and in the balance sheet information, we have fixed assets, current assets, and equity. If it adopts the new strategy, sales will grow at the rate of 20% per year for the 3 years. Now, this new sales strategy can be anything. Let's say, for example, it can be enhancing the credit period, or else, they are spending more on the advertisement cost, or like whatever. So, but based on that, is there going to be any increase in the sales? Come on, yes or no? Yes. So, our existing sales is going to enhance. From the 4th year onwards, the cash flow will be stabilized and the gross margin ratio, asset turnover ratio, and the capital structure and the income tax rate will remain unchanged. Depreciation would be at 10% net fixed assets at the beginning of the year, and the company's target rate of return is 15%. Determine the incremental value due to the adoption of strategy. So, my dear students, we have to find out the value of the existing strategy, and we also should find out what is the value of your additional of your new strategy. The difference between the two will be called as your incremental value of the strategy. Okay. So it's important for you to find out the value of the existing strategy. So for your existing strategy, what are you going to do? So we'll be having sales, then there will be gross margin at the rate of 20%. Administrative expenses at the rate of 10%. NPBT less tax will be getting NPBT. Now this NPAT, my dear students, we have to capitalize it at the rate of 15%, because that is the discounting factor which they have told you that the company's target rate is 15%. So based on this, my dear students, we will be getting the value which is 9,333.33. That is the existing value of the strategy. This is very easy to calculate because we have sales, we have GP margin, we have administrative expenses. They have also told you NPBT, which is 10% of the sales. We subtract tax from it. We'll be getting NPAT, and this NPAT, because if we don't adopt the new strategies, this NPAT is going to be constant till perpetuity. So what we need to do is simply take this NPAT and capitalize that by 15%. We'll be getting the value, which is 9,333.33. So that is the value of the existing strategy. What is the value now of the new strategy? Now I want your full attention here, because here we have to prepare the income statement like this. We'll be having sales, gross profit, less administrative and selling expenses, which is 10%, NPBT, which is 10% of sales, less tax, we are going to get NPAT, and depreciation will be getting the cash flows. Now, my dear students, this cash flows, we need to check whether there is going to be increase in fixed assets or not. So, my dear students, they have told you that the asset turnover ratio is going to remain the same. Now, they have not directly told you that there is going to be any increase in the fixed assets. But always remember like this, that if the asset turnover ratio is going to be kept constant, don't you think, my dear students, if the sales will increase, then the assets are also going to increase, which eventually means that there is going to be some investment in the fixed assets. Okay. So always remember like this, that they will not give a specific statement, but if they give you something like this, that the asset turnover ratio is going to remain constant, what does it imply? That whatever was your asset turnover ratio existing, it's going to remain the same. So that is why if the sales increases, your investment in assets are also going to increase. So we'll be preparing it for the period of 4 years. Now, why again 4 years is because they have told you from fourth year onwards, the cash flow will be stabilized. So that's why year one, year two, year three, year four, the cash flow is going to stabilize. Okay. So we will prepare the income statement. Now, in this particular case, we'll be having sales. So your NPBT is 10% of the sales. So whatever was your existing sales, which was 20,000, we added 20% to it. So it gave you 24,000 GP at the rate of 20%. So this will be 4,800 admin, selling, NPBT, tax, NPAT. To this, we add back the amount of depreciation, we'll be getting the cash flows. And from this cash flows, then we'll be subtracting investment in fixed assets, investment in working capital, we'll be subtracting it. We'll be getting your free cash flow for equity. Okay, so whatever is your increase in investment in fixed assets and increase in investment in working capital, we have to subtract it, and eventually we'll be getting FCF. So how did we get this particular figure of there is increase in fixed assets? So first of all, we need to calculate what is your existing turnover ratio. So are we having fixed assets? Yes, sir. Are we having sales? Yes, sir. So this will now give you your fixed asset turnover ratio, which is 5 times. Now, my dear students, this 5 times is going to remain the same in future as well. So in this particular case, 5 is equal to sales upon fixed assets. Your sales, in this particular case is, sorry, your asset, that was just a rougher calculation. Your asset turnover ratio is sales upon fixed assets, 20,000 upon 8,000. So this is nothing but 2.5 times. Okay. So 2.5 times is your turnover ratio. So when the sales is going to be 24,000, what is going to be your turnover ratio? What is going to be your amount of investment in fixed assets? So that fixed assets is going to be 9,600. Now, my dear students, just look at this. Your opening fixed assets was 8,000. Your closing fixed assets is going to be 9,600. Okay, because based on the asset turnover ratio, when the sales will become 24,000, your total asset turnover ratio is 2.5 times. Because of that, your fixed assets is going to be 9,600. Now, you have opening, you have closing. Have they given to you any information about depreciation? Yes, sir. They have told you that depreciation would be 10% of the net fixed assets. So, my dear students, we have to now charge depreciation. So, on 8,000, 10% rate. Okay. And that is going to be on net fixed assets at the beginning of the year. So 8,000 is the fixed assets at the beginning. So at the rate of 10%, this will be 800. The balancing figure will represent your cash back. That is the new purchase of the fixed asset. And if, guys, there is new purchase of the fixed assets, should your cash flows be reduced by the same? Come on, yes or no? Yes, sir. It will be reduced by the same. That is 2,400. Once again, you all can check this out. See, we are going to first calculate what's the closing balance of the fixed asset. How will we calculate the closing balance of the fixed asset? Very simple. Whatever is your sales, we are going to apply our turnover ratio to it. We'll be getting the fixed assets amount. So once we have got the fixed assets amount, we add back the amount of the depreciation, and then we subtract the opening balance of the fixed assets to get the purchases figure. Because opening, depreciation, and your closing balancing figure will give you purchase. So if I have a closing part, we'll add the depreciation, we'll subtract the opening balance, ultimately we'll be getting the purchase. The same process we have to do it for year 1, year 2, year 3, year 4. And based on that, my dear students, there is purchase of your fixed assets, and this purchase of fixed assets, I need to subtract it here. What about working capital? Working capital, we can do it directly because they have told you asset turnover ratio is going to be the same. which automatically implies that your working capital turnover ratio is also going to be the same. So that is why your working capital turnover ratio is coming as 5 times, and this 5 times will be remaining constant. Okay. So whatever is your sales, based on that, you will come to know that your closing working capital should be 4,800. Now, the beauty of working capital is what? It keeps on getting rotated in the business. So if the working capital amount is increasing, we just have to invest the differential part. Okay. So your opening working capital is 4,000, your closing is 4,800. It means that there is going to be increase in working capital of 800. Okay. Similarly, here there is going to be increase in working capital of 960. Here there is increase in working capital of 1152. Okay. And we have to just post all these things here in our income statement as a subtraction. This will give you your free cash flow for equity. But here the emphasis should be made for the fourth year. Okay. Why? Because till 3 years, I hope you all have understood this entire calculation. For the fourth year, now, for the fourth year, they have told you that the cash flows are going to remain the same. So this will continue to be, sales will be 34,560. GP is this, NPBT, tax, NPAT. Now, my dear students, here the important part is what is going to be your amount of depreciation. Okay. See, guys, uh, in this particular case, you all can just check that your depreciation here. See, because this is 13,824. So your opening balance, on your opening balance, you have to charge the amount of the depreciation, and your opening balance is 13,824. So as you all can see that the depreciation of 13,882.4. This is nothing but what? Whatever is the depreciation on the opening balance. So opening balance was 13,824, right? So year 3 closing becomes year 4 opening. So opening is 13,824. Closing is also coming 13,824. Why is the closing coming the same? That is because that your sales are going to remain the same for the fourth year. So based on the asset turnover ratio, obviously your closing is also going to come as 13,824. Now the journal entry for depreciation is depreciation to fixed assets. So here we'll be writing down the depreciation part, which is 10% of this, which is 1382.4. Automatically your balancing figure here will be cash bank, which is 1382.4. This concept is called as offsetting your increase in capex with your depreciation, because you can see that both the things are same. So it gets offset. Okay, opening and closing are same. So your depreciation and your investment in fixed assets both are going to be the same. Okay. So, and this usually happens under what circumstances? That when the sales are remaining the same and the closing fixed assets, opening fixed assets, both are same. So based on that, we'll come to know that there is going to be increase in fixed assets. What about your increase in working capital? Now, if the sales are not increasing, then obviously the need for working capital is also not going to. So is it going to remain the same? Yes or no? Yes, sir. So that will is going to be the same. So there is not going to be any single increase in your working capital. And based on this, we'll be getting the FCA. What we need to do with the same, now we have to discount it and we have to bring it to the present value terms. And eventually we'll be getting 8643.32. Okay. So because from fourth year onwards, the cash flows are going to be constant. Can we calculate terminal value at the end of the third year? Yes or no? Yes, sir. Okay. So that is why the terminal value at the end of the third year is 16,128. Okay. And ultimately, we'll discount all these things and bring it to the present value terms, ultimately 8643.32. And then, my dear students, if you guys can just check, you will come to know that we have your final value of 8643 and your opening, your old strategy was 9,333. And as you all can see that this is negative. And because this is negative, incremental value is negative. Should we go for the strategy or should we reject the new strategy? Answer is we should reject the new strategy. Okay. Now, my dear students, after this, let's conclude for with your question number 5. Let's now commence with question number 6. Following information are available in respect of XYZ, which is expected to grow at a higher rate of for 4 years, after which the growth rate will stabilize at a lower level. We have the base year information, which there is revenue, there is EBIT, capex, depreciation. Information for high growth and the stable growth period are as follows. So we have high growth, we have stable growth, we have growth in revenue and EBIT, growth in capex and depreciation. My dear students, they have told you growth in capex. So by how much percentage the capex are going to grow, they have told you directly. So if suppose in the last year I had spent 100 crores in capex, then in the current year I'll spend 120 crores. So there is going to be increase by 20 crores. So when I'll be calculating the cash flows, I have to subtract what is going to be increase in capex. So that increase in capex will be 120 crores, which will be directly available. We have the risk-free rate, we have beta, we have market risk premium, we have pre-tax cost of debt, we have debt equity ratio. And working capital is 25% of the revenue and the corporate tax is 30%. What is the value of the firm? So we are required to calculate the value of the company. So for that, we will need income statement. So this is our format of income statement. We have revenue, we have EBIT from which we subtract tax, we'll be getting NPAT. We add back the amount of depreciation, we'll be getting cash flows. Okay. Now, my dear students, this cash flows, we are going to increase in fixed assets, we are going to increase in working capital, ultimately we'll be getting the free cash flow for firm. Okay. Now, my dear students, you all can just check that your base year information revenue was 2000 crores and this growth is by 20%. So this will become 2400. EBIT is also growing by 20%, right? So that will become 360 crores because last year it was 300 crores. So we're going to add 20% to it. So that will become 360 crores. Okay. Tax is 30%. We got the NPAT. What about your depreciation? So they have told you that the depreciation is also going to grow by 20%. So this will become 240 and based on this, your cash flows will be 492. Now we have to subtract the increase in fixed assets. So here there is no need to prepare any ledger account. You know why? Because they had given to you that the last year capex was 280. And this capex itself is now going to grow at the rate of 20%. So my dear students, this capex of 280 crores, we have to add directly 20% to it. Eventually, this will now give you your 336 crores. Your working capital increase is going to be there. Why there will be working capital increase? Because as you all know, that working capital is 25% of the revenue. So first the revenue was 2000. If you multiplied by 25%, this was the working capital which was required. Now, if the revenue increases by 20%, it becomes 2400. I need to multiply 25% to it. That will give me my new working capital. The difference between the two will be called as your increase in working capital. Okay, so that is coming as closing minus opening 100. So working capital will be increased. Okay, so for 4 years it's sorted. But now, my dear students, what's happening in the fifth year? In the fifth year, as you all can just check, they have told you that the growth rate will stabilize at a lower rate. Okay, so that's perfect. Growth rate is going to stabilize at a lower rate. And they have given to you this data where there is increase in 10%. So here I have to add it by 10%. Then EBIT. They have told you EBIT will also increase by 10%. Okay, then tax will be getting in. And then they have told you that capital expenditure are offset by depreciation. This is something we just saw in the previous part. That when opening closing of fixed assets are same, your depreciation gets set off with your investment in your capex, right? So capital expenditure are offset. So in this particular case, this depreciation and increase, we both are not writing down this particular figures. This will be 479 and increase in working capital, if any. Yes, because this is increasing by 10%. So there might be some increase in the working capital required, which is coming as 103.68. Ultimately, this is 375. So now, my dear students, this 375.32 is going to be constant in perpetuity. So obviously, we can calculate terminal value at the end of the fourth year, because from fifth year onwards, if it is constant in perpetuity, we can calculate terminal value at the end of the fourth year by taking FCFF at year 5 upon KO minus G. So based on this, we'll be getting the value, discounting this at KO, and eventually we'll be getting the value. So how do you calculate your KO? So my dear students, your KO needs to be calculated on your WACC basis. So here, if you guys can just check, okay, one most important part here. We'll be calculating KO. In the high growth segment, the debt equity ratio is 1:1, right? And we have the risk free rate of 10%. We have the equity beta, we have the market risk premium. This data will help you to calculate your KE using CAPM. And we have the pre-tax cost of debt, that is 13%. So this 13% we need to multiply it by 1 minus tax and get it post-tax. Okay. So eventually we'll be getting this WACC, which is coming as 12%. And for your initial 4 years, your WACC, which is coming as your 13%. Okay. So because there are two data given to you. Now, why do you need two KOs? Because if I want to calculate what is the terminal value at the end of year 4, I need to take whatever is going to be my cash flows, free cash flow for firm at year 5 upon KO minus G. So do I need the KO here? Come on, yes or no? Yes, sir. So this KO which I need, I will take for slow growth purposes, right? Because this is the FCFF for 5th year. So for slow growth basis, whatever is the KO, so that needs to be taken into consideration. So we'll use this data to calculate your terminal value at the end of the 4th year. And once we get that terminal value, so now for this 4 years, if I want to discount it and bring it to the present value terms, I will use which KO? The KO which is calculated for the initial 4 years. So this is the difference which you have to understand, because many students make a mistake here. You have to understand that from 5th year onwards, if your cash flow is going to be constant, come on, yes or no? Yes, sir. So terminal value at the end of the 4th year, you have to calculate by taking 5th year cash flows upon KO minus T. But what should be your KO here? So here your KO should be obviously this particular part. From slow growth data, we'll be calculating the KO. So this will help you to calculate the terminal value. And this terminal value is at the end of the 4th year. So now if I'm discounting the cash flows from year 1 to year 4, which KO should I use? The KO which is there in the high growth model. So this particular KO I'll be using it, and then I'll be getting it into the present value. Okay. So this is something which we are going to do in your question number 6. Now question number 7. Again, this is going to be a question which there will be too many calculations here. Okay. So I just want you to focus very, very, very thoroughly and don't get lost in between. Okay. Very important question. Okay. This has many concepts which we need to cover here. So let's get started with your question number 7. So what is given to you in this particular question, that BRS Inc. deals in your computer and IT hardwares and peripherals, and the expected revenue for the next 8 years is given to you. We have the summarized financial position as on 31st March 2012, which was equity stock, there is 12% bonds, fixed assets, and then there is current assets. And we also have variable expenses, which is 40% of the sales revenue, and the fixed operating expenses cash are estimated to be as follows. For year 1 to year 4, it is $1.6 million, and year 5 to 8, it is $2 million. An additional advertisement and the sales promotion expenses shall be launched, requiring expenditure as per the following details, in which there is period 1, 2 to 3, 4 to 6, and 7 to 8, and we have these expenses. Fixed assets are subject to depreciation at 15%, but this is on your WDV basis. Okay. And also, they have told you that the company has planned additional capex at the beginning of each year, and they have given to you investment in working capital is 20% of the revenue. Applicable tax rate is 30%, cost of equity 16%, and the free cash flow of the firm is expected to grow at 5% per annum after 8 years. We are required to calculate what is the value of the firm and what is the value of the equity. My dear students, this is a very massive question. I have made a very detailed video on how to solve this particular question, which is there on our YouTube channel. But I'll be revising this very quickly for you, and it's going to be a little bit lengthy. See, first of all, in this particular question, for valuation of the firm, when they ask you to calculate the value of the firm and value of equity, we can definitely calculate your value of the firm based on your FCFF model. And after we get the value of the firm, from that we subtract the value of the debt, we ultimately get what? Value of the equity. Okay. So for value of the firm, we need calculation of the KO. So do we have debt and equity both in the capital structure? Yes, sir. So we do have debt and equity both, and based on this, we got your WACC, which is coming as approximately 13%. Now we need to prepare the income statement for 8 years. We have sales, variable cost, fixed cost. Then we have advertisement expenses, net profit before interest, depreciation, and tax. And mind you, we are just going to subtract depreciation and not interest. Why? Because this is your FCFF. So interest we are not going to touch. From your EBIT, we'll be subtracting tax, we'll be getting NPAT, add depreciation, we'll be getting the cash flows. And then we need to see what is increase in fixed assets and increase in working capital. Now, my dear students, your first working note is how do you calculate the depreciation? See, because we have the sales available, nothing to worry. We also have your variable cost, which they have told you is 40% of the sales. So we can get the variable cost as well. We also have fixed operating cash cost, which is going to be this particular part. And then, my dear students, we are going to have this additional advertisement expenses as well. Ultimately, there will be net profits before your interest, depreciation, tax, and that's why we need to now first start with calculation of your depreciation. So depreciation, my dear students, we have opening, and they have also told you that we are making some purchases of the depreciation. So this is going to be your additional capex. So that is why from your opening you add the purchases, will be getting the total. Depreciation is at the rate of 15% and it's going to be on WTV basis. So that's why we need to prepare this table. If I solve this particular question right now, it's going to take an hour. So that's why we'll quickly revise this. We'll be having the depreciations, and this depreciation, my dear students, we can add it here. Ultimately, we can get the cash flows. Okay. So first of all, see, depreciation will be subtracted here. EBIT, tax, NPAT, depreciation, cash flows. The crux of this question is, how do you calculate your increase in fixed assets? It means that how much amount are we going to spend in your fixed assets and how much amount is going to be in working capital. So you'll be saying, okay, sir, it's so damn easy. We already have your investment in capex 0.5. So why not we directly subtract from here 0.5 and do that accordingly? Then the answer is no. You know why, my dear students? Because they have given to you in this question your current assets as 3, which signifies that you already have a working capital of 3. And they have specifically told you that the working capital is 20% of the revenue. So my dear students, just imagine if suppose you are going to have, a revenue of existing revenue of, let's say how much is it? 8. Okay. So what is the working capital requirement, guys? It is 8 into 25%, right? Because we need working capital, which is nothing but 20% of the revenues. 8 into 20%. So we just need 1.6 amount to be placed in working capital. Now, my dear students, once we only need 1.6 to be invested in the working capital, but you guys can just check that we are already having $3 million of working capital with us. So this is actually our hidden adjustment. So we are having $3 million. We are having existing working capital as $3 million, but we just need the investment in working capital as 1.6. Don't you think you are left with the balance part, that is 1.4? Come on, yes or no? Yes, this is the recovery of working. And now can I use this recovery of working capital for making investment in capex? Yes or no? Yes, sir. So this is something which I want you to understand very thoroughly. So you have year one capex 0.5, which is to be made. And my dear students, working capital is just 20% of your revenue. So the total requirement is 2.1. But you are having 3. So first of all, in the very first year, we don't have to invest anything in capex. You know why? Because your total requirement is 2.1 and your availability is 3. So rather you have surplus. Okay. So that is why you all can just see in the very first year, the increase in fixed assets and increase in working capital is 0. Why? Because you already had 3. And the requirement of fixed assets plus working capital, both of them put together is 2.1. So that's why 0.9 is the surplus, right? So additional funds required is nil. Now, uh, available working capital is $3 million, and in which 1.6. So extra working capital was 1.4, from which we have purchased capex. So that's why you are left with now $0.9 surplus. Okay. Now, in the very second year, are we investing in capex? Yes, 0.8. But also at the same time, don't forget that we also have to maintain the working capital. So working capital here, my dear student, should be 20% of the revenue. So 10 million is the revenue on that 20%. So 2 million is the requirement part. But we have already arranged 1.6. So the additional part is 0.4, which gives us that the total requirement is now 1.2. And did we add the surplus of 0.9? Yes, sir. So what is the funds required now? It's just 0.3. So now, my dear students, here in combination, we know that 0.3 is the additional amount which is being required. So once again, see, I'm just revising this very thoroughly. We have this 0.8 as the investment in capex, and this is the increase in working capital required. Okay. So the total amount which is required is 1.2 million. And out of that, my dear students, we already have 0.9. So the balance part required is what? 0.3. So that is why that will be spent from the cash flows. So the cash available for your firm is going to be lower. So that is why this will now be 2.4. Then again 4.82, now there is no such surplus left. So we will simply take whatever is the requirement that needs to be taken into consideration. So 2 million here. And also, my dear students, you have to understand one concept, that whenever there is working capital, which was whatever was the revenue, on that we need to multiply it by the same percentage, that is 20%. So you will come to know that this is the total amount of the working capital required and how much you have already arranged it in the previous year. So the difference is only your incremental working capital. So for working capital, just put this in your mind that we need to increase the working capital and do that accordingly. Okay. So this will eventually give you your final FCFF. And once we get the FCFF, what we need to do is we just have to now discount it and bring it to the present value terms. Okay. So here, as you all can see, 1, 2, 3, 4, 5, 6, 7, 8, and then the cash flows are going to be constant. So we'll be using your terminal value, which is FCFF at year 9 upon KO minus G. This will give you 85.97. Eventually, this is 92.52, which we need to discount at 13%. And eventually, this is the value, which is 50.89. So this is how, my dear students, we are going to solve your question number 7. Again, I'm repeating, I've already disclosed this particular, I've already discussed and solved this entire question in the YouTube video. You can check that out. Okay. Now, after this, my dear students, what is your question number 8? So in your question number 8, oh, this is nothing, but we are required to calculate what the range of valuation. So what is the range of valuation, minimum and maximum value? This is something which you all can manage it. Okay. Question number 9, my dear students. Question number 9 is very similar to what we have done earlier. Here also, depreciation is going to be offset by the increase in capex. As you can see here, incremental capex will be offset by the depreciation. So this kind of data is given to you. So that is why it is very much manageable. But here, the only thing is they have specified that capex net of depreciation will grow at the 15%. So till now, only capex was growing at 20% and depreciation was growing by 20%. Here they have told you capex net of depreciation is growing by 15%. So that is why, what I will do is, see, from NPBT we subtract tax. What do we get? We get NPAT. To this NPAT we add the depreciation, we get the cash flows. And then, my dear students, any increase in fixed assets we subtract it, right? So now they have told you that the fixed assets net of depreciation is increasing. What is net of depreciation? FA less depreciation. So there is no need to add any depreciation here. Whatever is the cash flows, directly we will subtract increase in the net fixed assets. So that will give you the better understanding and how to solve that particular question. So as you all can see here, uh, okay, now, fine. So see, from NPAT, we are directly subtracting what? Net of capex. So NPAT add depreciation gives you cash flows. From that you subtract, whatever is your increase in capex. Instead of doing all these things, what we will do is, from your NPAT, we will directly subtract increase in your net capex. Okay. So this will be your sales, COGS, operating expenses, 3420, whatever is the depreciation, tax rate, NPAT, increase in net capex, and then increase in working capital, your FCFF. So your increase in net capex, they have given you the data by how much percentage is increasing. So see here, it is 750 crores. Depreciation is 600 crores. So this will give you your net capex. And this net capex, my dear students, we are going to add it by 15% to get the answers. Okay. So that is how your increase in net capex will be done. So with this, my dear students, I have revised 9 important questions of your business valuation. I hope you have understood this till now. Okay, now very quickly we'll be doing something which is called as a chop shop method. Now this type of the question is actually required when there is conglomerate type of a merger. So when there are different types of your businesses, then how do you value the company as a whole? So for that, we are going to use this chop shop approach. So what happens in a chop shop approach is that we have to, we need to calculate. See, there is a business segment which is given to you, wholesale, retail, and general. See, market caps actually can be calculated for each and every segment. So objective here is what? Very simple. Let's say, for example, a company has 3 divisions. Okay. So A, B, and C. What we need to do in chop shop method is we need to find out what should be the market cap of all the 3 divisions. Okay. And we need to sum it up. So this will give you the total market cap of the company. So now to get the market cap of each and every division, it is not necessary that the market cap is calculated only by one method. The market cap can be calculated by multiple methods. Suppose there are three ways to calculate the market cap on the base of P ratio, enterprise value ratio, any particular ratio. So based on that, we have now got three market caps just to measure one division. So I cannot take the summation of all the three methods, right? So what I need to do, I have to take the average of it. So let's say for division A, we want to find out the average market cap. So there are three methods. We will sum it up, divide by 3, we're getting the average market cap. And this average market cap, my dear students, is for division A. The same way we will do it for division B and division C. So that is going to be your, final answer. See, as you all can see, valuation is as per chop shop method, wholesale, retail, and general. If market cap is based on sales, okay, then these are the three market caps. If it's based on assets, these are the market caps. And if it's based on operating income, these are the market caps. And they have given you the indicators here. Okay, so what is it? Suppose your segment sales wholesale is 2,25,000 and capitalization to sales is 0.85. So what will you do? Capitalization to sales is 0.85 and I have the sales figure available, which is nothing but 2,25,000. So will this now help me to calculate what should be my market cap? Yes. So that will be 191,250. So similar to that, we need to calculate the market cap for each and every division. And then we'll get the average market cap and add it. So that will be treated as a value of the company. Okay. So this is something which I just wanted you all to discuss. Now, let us come to the economic value added and market value added. So whenever we are going to talk about your EVA or economic value added, always remember like this, that economic value added is nothing but the addition which the management is doing due to its efficiency in its operations. So basically, if suppose you have a capital employed of 100 crores and suppose your cost of capital is 12%. Okay, but if suppose you are earning more than 12 crore rupees, then there is economic value added. So when your net operating profits after tax is greater than whatever is your amount invested into your WACC, which is also known as capital charge. So then in that particular case, will there be an economic value added? Come on, yes or no? Yes, sir. So very simple concept. Whenever we deal with economic value added, we just have to see whatever is the net operating profits after tax. From that, we just need to subtract your capital charge. So we will come to know that what is the value addition which is being done. Okay. So basically, there are some steps which you all have to understand whenever we deal with your economic value added. Okay. So it is used for measuring your management's efficiency. It is NOPAT minus amount invested into WACC. If AVA is positive, it indicates that there is value addition. Okay. So we will solve just couple of questions in this and I'll tell you the important part in economic value added, or else it's extremely easy for you to understand this. So again, is the EVA a tool for the purpose of measuring the operations? Come on, yes or no? Yes, sir. It is a tool for measuring the operations. Okay. Now, what is the efficiency? So for that, we need net operating profits after tax, and from that we subtract the capital charge. Okay. Now, in this particular question, you all can see that this is your revenue, direct cost, EBIT less interest, EBT tax, and then we have your property, plant and equipment, current assets, equity reserves, non-current borrowings, and current payments. Assume that the bad debts provision of 20 lakhs is included in the selling, general and administrative, and the same amount is reduced from the trade receivables. And the pre-tax cost of debt is 12%, tax rate is 30%, and the K is 8.4. So based on this, we are required to calculate your EV. So EVN can very easily be calculated in 3 steps. First step, determine NOPAT. Okay, net operating profits after tax. Second, what is the amount invested? Check that out. And third, what is your KO? Okay. So we are just required to calculate these 3 things. So first is calculation of NOPAT. Now your emphasis is to be made that whenever this net operating profits after tax needs to be calculated, it should be on cash basis. So that's why we have to just adjust the non-cash expenses except for depreciation. Because in EVA, you have to understand this concept that whenever we are calculating the economic value added, whatever is the depreciation component, that depreciation component is treated as your operating expenses only, so there is no need to adjust it. But other non-cash expenses like provision in bad debts or provision in diminution of value of investments, are these need to be adjusted? Come on, yes or no? Yes, sir. So once again, I'm repeating, if there is depreciation given to you, are we going to adjust the depreciation to calculate the cash NOPAT for EVA purpose? Then the answer is no. But if there is other types of non-cash expenses, provision for doubtful debts, provision for bad debts, are we going to consider that? Come on, yes or no? Yes, sir. So for calculation of economic value added, you all can just check that we have to first calculate NOPAT. So we have the EBIT, from that we subtract tax, we get the net operating profits after tax. So once we have got the net operating profits after tax, we need to add your provision for doubtful debts, because that's a non-cash expenditure which is given to you in the question. So we'll be adding it, we'll be getting the cash NOPAT. Okay. What is your amount invested or capital employed? You can do that accordingly. So when we are adjusting whatever is going to be your PFDD in your NOPAT, then we also have to adjust that while calculating your capital employed. Okay. So very simple logic, my dear students, that if suppose there is provision for doubtful debts, so your P&L account gets debited. So because of that, the profits are reduced. Okay. Now, my dear students, whenever we are calculating the net assets or the amount of the capital which has been invested, so the amount invested is definitely higher. So this was just a book entry which we had passed, provision for doubtful debt. So that's why we have to add back this non-cash expenses, that is PFDD. Similarly, the debtors which was recorded, that was less of PFDD. So because we are adding the PFDD in the second step, in the first step, we also have to add the PFDD in your calculation of your debtors. Okay, so we have to add that. And then guys, we are required to calculate your WACC. So here we have equity, reserves, long-term loans, we have their weights, we have their after-tax cost. And guys, ultimately we'll be calculating the economic value added, which is NOPAT minus capital employed into WACC, which comes as 229.3. So EVA ideally is a very simple concept, yes, but there is only just one thing which I wanted you all to understand in economic value added is that if suppose there is any intangible asset which is still not recorded in books, should you consider that as the part of the capital employed? Then the answer is yes. Okay. So in this question number 13, we are having an average income of 12 lakhs after tax, and the patent has 8 years to run it, and Herbal has been offered 40 lakhs for this patent rights. Okay. And Herbal assets include 20 lakh of working capital, 80 lakh for this. But the patent is not shown in the Herbal's books. But should we consider that in valuation of EVA? Then the answer is yes, sir. Okay. So this is something which I want you all to understand, that we have the NOPAT available, the amount invested, and we are also considering patents as the part of the amount invested. So always remember like this, even in case of intangible assets, will it be forming part of your amount invested? Yes or no? Yes, sir. Ultimately, then we'll be getting the economic value added, which is coming as this. So I hope, my dear students, you all have understood this, because rest all questions are on your economic value added only, which is quite reasonably you'll be able to solve it. And regarding the practical problems, all the important concepts of all the practical problems, I've revised it. Other things, just go through once again, and please solve some questions from the study module as well. Okay, if you all are my students, then there is no need. But others, you all can just check your study module for other practice of EVA questions. So that's it from my end. I hope you all have understood this. I've tried to cover as much as possible in the minimum time which I have. Just practice, practice, practice a lot. Bye guys. Take care. See you.